Tata Motors skids more than 3% on the back of quarterly results. Although the numbers beat street expectations, the company's global outlook and JLR's commentary remains cautious. The stock now down 4%.
Eicher Motors and Maruti, they too skid post weaker July auto sales data. Total domestic sales for Maruti declined by around 5.3%, while Royal Enfield sales for Eicher Motors came in lower by 8%.
Cummins India declines on the back of negative commentary from the global company's parent. Cummins Inc. says that the revenue for 7 entities in India, including 3 JVs, saw 10% decline year-on-year.
Zomato zooms more than 10% after delivering a good quarter. The revenues jumped by 74% from a year ago. Brokerages also issued bullish calls on the stock.
Weak results coming in from Pratap Snacks and Somani Ceramics, pushing the stocks lower. EBITDA declined 8% for Pratap Snacks, while EBITDA for Somani declined by about 3.5%, citing seasonality challenges in the first quarter.
Hello and welcome to Chartbusters. I'm Nigel D'Souza, and joining me as always is Mangalam Malu. Well, the screen is red, but I think it's not as bad as feared, because in the first 90 minutes or so, the breadth of the market actually has improved. When we started off trade, there were 300 stocks that were advancing. Currently, you have close to around 800 stocks that are advancing, so those crisscross lines are getting a little bit closer to each other. And big boy HDFC Bank that we pointed out earlier today as well. Yesterday as well, it came to life in the final hour of trade, and today as well, that's at least holding one end up. Mangalam.
Absolutely, Nigel. It may have the tailwind of the impending flows of the MSCI as well sometime in this month. So that is something we'll keep an eye out on. Of course, the stock had rallied before the announcement all the way up to 1800. That time it was an overheated trade, all of that. Thereafter, we had the numbers, the update, etc. Went all the way down to 1600. And from there, it's seen a bit of an up move that we're seeing as well. The broader market is doing extremely well. Not only is Zomato, the holding company of Zomato, Info Edge 2, has surged to the high point of trade with a gain of almost 5%. Granules, India Cements, Oil India, NBCC, a lot of the stocks in the broader markets actually doing a lot better. Private sector banks, along with HDFC Bank, we've seen Kotak Mahindra Bank move higher as well. So keep an eye out on that too. So let's talk about a lot of these stocks which are in focus. One of them on our radar is Redington. The company reported weak performance in the first quarter. The revenue declined by about 5% sequentially. We do have with us V.S. Hariharan, who's the Group CEO of the company, joining in to discuss the numbers in detail. Thanks a lot, Mr. Hariharan, for joining in. One important question is with regards to your revenue itself. The first quarter revenues were weak. What do you attribute this to, and will you see an expansion in the second quarter? I mean, you said that there was muted spending on account of elections, etc. So one wants to get a sense of what kind of pickup that you've seen in the second quarter, and as a result of which, what's your outlook for the remainder of this year?
Thanks, Nigel. I'll talk a little bit about the quarter and then where the weakness came from. We had a really good quarter, actually, the highest Q1 revenue recorded at 21,335 crores. If you look at the performance outside of Arena, the subsidiary in Turkey, in India and Middle East Africa, it was a continuing story of profitable growth at 13% year-on-year with a PAT of 1.42%. And we had a good growth in India and in parts of MEA, 6% growth in India and 17% growth in UAE. We also saw signs of profitable growth recovery in Africa and Egypt. Parts of the things that went that could have been better and got muted a little bit was because of elections and some of the capital decision delays in India, as well as Saudi Arabia. Some of the projects got pushed out because of some government decisions. We also saw festive holidays, almost 3 weeks in Middle East Africa and Turkey. And some of these had an impact on our ability to do more. But if you look at the overall story for growth in India and Middle East Africa was good. Turkey, we had market conditions, and because of which the PC market declined in Turkey, and that caused a bit of a setback on top line and bottom line. But purely India and Middle East Africa, we had good growth trajectory, and it's only going to get better in Q2, to your question on Q2.
Right. Which is what we want to understand, Mr. Hariharan. You've spoken about all these things. You've, detailed these in your post-earnings note as well. I just wanted your thoughts on what is the kind of recovery that we will foresee from here on. I mean, for perspective, first quarter, your growth was just 0.4%. Earlier, it has been mid-teens, sometimes as high as 25-30% as well. So what's the kind of recovery? And in light of that, what's the growth that one should expect for the entire year?
So there are several factors we see in Q2. The first month has already got off to a very good start. We see the technology solutions group with the buying and the government and corporates coming back. And so we should have a good quarter on that, both in India and Middle East Africa. Similarly, on the mobility solutions, the NPIs, some have happened and some are going to happen at the end of this quarter. And we see a good pickup on that. Cloud has been growing at 35 to 40%, and that will continue to grow. And the last quarter in India, we saw PCs, consumer PCs and commercial PCs actually growing very well, and that will continue to grow. So we're quite bullish about Q2 across the geographies except Turkey. And if you look at the year per se, when you talk about the year, the projection for the year from analysts is 10% growth in India and about 8 to 9% in MEA. And we're definitely not going to lose share. We're going to keep share or gain share. So we definitely have an expectation to grow at the market rate, if not faster.
Okay, all right. Hi, Mr. Hariharan. This is Nigel on this side. You briefly mentioned about cloud, and it's growing at a good rate of around 35% approximately. But currently, as a percentage of your mix, it's less than 2%. How do you see this part of your business scaling up, say in the coming year, that is FY25, and with the 3-year time horizon, how do you see that scaling up? And also for your overall margins, it's still very, very subdued. I liked how you squeezed in that bullish commentary maybe for the second quarter of this year. For the year, what kind of margin should we work with?
So let me answer the first part of the question with regards to cloud. Cloud has actually become now more than 3%. So this quarter's first time we saw between 3 and 4% of the mix. So it's definitely growing because it's growing at 35 to 40%. For this year, maybe it'll be still at 3 to 4%. And profit-wise, cloud is beginning to deliver the similar profitability levels as our overall profitability for Redington. So which is good news. It's growing with the investment we are making. The profitability is also turning in. The gross margins will come back to original levels of gross margin for the rest of the year. We had a number of factors playing in, as I mentioned before, because when the technology solutions, which is a higher margin business, once that starts coming back, our margins will rationalize. Also, the NPIs on mobility, as I mentioned, will bring up our gross margins. So our gross margins should definitely step back by at least 0.5% over where we are.
Hariharan, just a counter question. 3 to 4% of your mix is what cloud is that? But do you see it gradually move towards double digits because of the pace of growth that you're seeing there? Say by 2027, that could be the objective?
Absolutely. I think in a 2 to 3 year horizon, we think it'll get towards 8 to 10% based on our current modeling. And that's what we're hoping. And within cloud itself, currently, the way we report cloud is only the hyperscaler business that we call out, but we also have a cloud business within technology solutions, which is called as software. Together, it's about $1 billion. And so that's about 10% of the overall group. So we report the infrastructure as a service, the hyperscaler business and cloud, but the others are about 700 million. If I look at it in total, it's about 10%, and we expect that to get to about 15% in 3 years.
All right. Just a final question before we let you go. Just, reworking basis what you've said so far, it appears that your revenue this year would grow between 8 to 10% and margins between 2 to 3.5%. Should we hold you on to that, at least for the full financial year?
Yeah, that's what we are gunning for. If market conditions are right, there's no reason why we will not achieve that.
All right, take that point. Thank you so much for joining in. We will obviously keep speaking with you at the end of every quarter to get an update on how business is panning out, how cloud is growing, and also what your business mix looks like going forward as well. Thank you so much for joining in. With that, let's move on. Talk about some ideas for profit coming in from our colleagues at Money Control Pro. And today we have Bharat joining in with the stock.
Today's ideas will be Royal Orchid Hotels Limited. While the demand in Q1 was affected by low business meetings due to Lok Sabha elections, heat wave, and low wedding dates, the demand has significantly picked up from the current quarter. We expect the company to deliver a healthy double-digit growth in the current fiscal. In order to tap the strong demand environment, the company has lined up aggressive room addition plans and aims to add about 1,900 keys over the next few years. This is about a 30% increase as compared to the current levels. Most of the room additions is planned via the asset-light management contract route, which is the primary business model for the company. Apart from this, the company aims to add few hotels on the revenue sharing basis and lease basis, which will provide a significant boost to the top line growth. The company will also launch 2 new sub-brands. The company is looking to enter new geographies and aims to be a pan-India hotel operator over the next few years. The hotel industry upcycle is expected to sustain over the next few years, which is beneficial for hotel operators like Royal Orchid. At the current market price, the stock is trading at an EV by EBITDA of 12 times FY26 projections. This is at a significant discount to the comparable peers like Lemon Tree and Sammy Hotels, and also at a discount to its own historical trading range. Hence, we recommend investors to add the stock in the portfolio.
Right, that is a call on Royal Orchid Hotels. We'll take a short break, come back. On the other side, we have the management of Indian Metals and Ferro Alloys, IMFA as we know it, joining in to discuss their quarter gone by.
Welcome back. As promised, let's focus on Indian Metals and Ferro Alloys. That's IMFA. The company had reported margins that were much better actually on a sequential basis. On a year-on-year basis, they were more or less flattish. To understand what's the way ahead and how are things shaping up, well, we have Mr. Subrakant Panda, who is the managing director of the company. Hi, Mr. Panda. Good morning and thanks a lot for joining in. Well, let's knock out a couple of factors out of the way. The volume's a little bit lower on a year-on-year basis. Even pricing was a little bit subdued. But yet your margins came in at more than 24%. How come? And also, given that now volume should improve from here on and the benefit of higher prices will flow in, do you believe that you can hold on to margins or better it from here?
Good morning, Nigel. Always a pleasure to be on your show. So in as much as the Q1 FY25 numbers are concerned, yes, we have certainly reported better margins than we had anticipated and talked about the last time I was on air with you. But actually, in terms of prices, we have done better than the average for the previous year. If you look at it, even on a whether quarter-on-quarter basis or sequential basis, we have done better. What has also helped is the fact that input costs are have come in quite a bit lower, in the sense that both thermal coal prices have come down, as well as, more importantly, metallurgical coke prices have come down. And that is what has helped us report better numbers, even though, as you correctly said, the volume for the year was, for the quarter was a little subdued on account of maintenance activities. Now, going ahead, first of all, in our press release, what we had talked about was anticipating better prices in H2 of the current financial year. But in as much as ongoing quarter 2 is concerned, that is traditionally a weak quarter on account of summer vacations in Europe and monsoons in the Far East and all of that. So we are seeing a little cooling off of prices from Q1 levels, currently about 106,000 per ton or something of that sort. But the good news is that costs are coming down further. So metallurgical coke prices definitely starting from next month will come down further in terms of what we are currently using and the new inventory which is there. So all of that coupled with volumes coming back to normal should see us, if not maintain the numbers that we've reported in this quarter, perhaps even improve upon it a little bit.
So you had earlier pointed out that you could do, a rough run rate of 150 crores per quarter in terms of an EBITDA. With these developments, where do you see that number heading? And if you could give us an updated guidance on the volume, this quarter was subdued. You expect some pickup in the coming few quarters?
So volume for this quarter was roughly about 61,000 tons, as I said, on account of maintenance activities. But going ahead, we should be back to the standard 66,000 tons. So that is in terms of volume. Now, in terms of prices, what you are asking, what we expect, or EBITDA, what we expect going ahead. Look, two contradictory thoughts. As you know by now, I normally don't look too much ahead into the future, given the fact that this is an industry which is cyclical. But there is a quiet confidence that H2 will be good on account of the fact that stainless steel production has been good. whether in China, whether in India, and generally, with demand being okay and production picking up, that should translate to good times, I would say. Don't forget one other factor, which is that non-integrated producers are also sort of handicapped a little bit by high or elevated chrome ore prices. That is something which doesn't affect us, given that we have captive mines. And therefore, all these factors taken together is something that is giving me quite confidence, barring, of course, unforeseen circumstances.
Okay, all right, Mr. Panda. I was just looking at production, both from Glencore as well as Merafi's. Both of them were down by mid-teens for the first half of the year. So it clearly shows that power shortage in South Africa is clearly playing a role. Your reading?
So, funnily, actually, in as much as power situation in South Africa is concerned, that is something that has been a bit more stable than usual in the last couple of months or so. But certainly it is getting more and more challenging to produce ferrochrome in South Africa is what my general take is. You have heard a large producer indicate its intent to get out of the smelting business and only hold on to their chrome ore mining bit. So clearly, I mean, there are things happening in South Africa which are difficult to fathom sitting this far away. But there are infrastructure issues. There are many other issues which are at play, and seeing that volume correction leads me to believe that you will have more and more ferrochrome production shifting out of South Africa and moving to China, which in a way augurs well for us, because keep in mind, China is a high-cost producer on account of being entirely dependent upon imported ore. So clearly, they provide a floor to prices, and for integrated producers like ourselves, that translates into a pretty healthy EBITDA margin.
All right, so that directionally should be a positive for you, though difficult to sit here and fathom about what's taking place in South Africa. Let's talk about here and now itself. I just wanted to understand from an industry standpoint, the Supreme Court, ruling that recently came in where it did say the power of state legislators to tax mineral-bearing lands and quarries cannot be limited by the parliament. Wanted your thoughts on this. If this were to happen, what happens next? And if not for you, for the industry, what are the kind of numbers that we're looking at?
So Mangalam, this is clearly a significant judgment that a 9-judge constitutional bench of the Supreme Court has delivered, and it has significant import going ahead. But, the dust has yet to settle, in the sense, as you know, a couple of days ago, there was a follow-up hearing to decide whether it would be applicable retrospectively or prospectively. So I think one has to wait and see how that pans out. So at this point in time, it's very difficult for me to comment on it. And we certainly don't have a hang of what the impact will be. So first and foremost, one needs to see whether it is going to be applicable retrospectively or prospectively, and then take it on from there.
If it is retrospective, do you have a number in mind?
No, I don't have a number in mind, but I would want to make one other point. When we talk about manufacturing competitiveness in India, a couple of things come into play. One is, of course, certainty of policies. And the second thing is the fact that if you look at minerals, they are already, subject to a lot of levies. So net, one would expect that, the sum total of all of this adds up to a number which is digestible. But like I said, no further comment beyond saying that let us first wait and watch whether it is retrospective or prospective and what actions follow thereafter.
All right, Mr. Panda, we'll let you go at that, but we look forward to having a chat with you maybe in the next coming few weeks, because the street believes that 220 crores of compensation is going to be coming to the company. So maybe once you announce plans what to do with that, we'll get you back on the channel and discuss more. Thanks a lot for joining in and giving us a fair outlook. Well, for the time being, we slip into a short break. You come back, we'll continue to focus on markets and stock-specific action. Welcome back. Keep an eye out on Adani Ports as well as BPCL from the Nifty pack. Both of them were down more than 2.5%. They have moved into the green. The Nifty as well has recovered close to around 60 points from the low point of the day. The Nifty Bank, that's the one that's fighting back in today's trading session. But we have run out of time on this edition of Chartbusters. You stay with us. Trading Hour comes up next.